Traditionally, the number one goal for any company is to maximize profit for shareholders. But for quite some time now, we've seen a new breed of companies who don't care at all about profit. If these companies are able to show large enough user growth figures, nothing else matters. And I'm not just talking about random background startups. Many of the most recognizable startups in the world have never made a single penny. Zillow, for example, loses around $200 million per year. Snapchat loses $1.3 billion per year. Lyft also loses $1.3 billion per year. But no one is as bad as Uber, who till just 6 months ago was losing $9 billion per year. By far the main reason for this is the insane growth is everything perspective of modern investors. They're willing to stomach insane losses not just for a year or two, but 5, 10, 15 years. But it seems that things are finally changing, and they're changing fast. In fact, funding has fallen off a cliff across the board. In Q1 of 2023, global funding had fallen to $76 billion, which is a 53% decline from the $162 billion that it was the year prior. And this was despite two massive deals with OpenAI and Stripe, who raised $10 billion and $6.5 billion respectively. Without those deals, funding would have been down to $60 billion or over $100 billion less than 2022. You would think that the startups that are affected most are the early stage ones that are just getting started, as the risk with these companies are the highest. But it turns out that the startups that are being affected the most are actually the late stage startups with insane valuations and a chronic money burning problem. As such, most of these companies are scrambling to get their act together. Uber, for example, has been magically able to reduce their losses from $9 billion per year to just $300 million per year. But not all startups are having such an easy time, as they're realizing that becoming profitable isn't as easy as they originally thought. So join me as we take a look back at how this new breed of companies even came to be, and what this funding cut means for some of the most well-known startups in the world. Seeing all of these massive companies constantly burn money, it's easy to think that that's just how tech works. But that's completely false. Companies like Apple, Google, and Microsoft pull in tens of billions, if not hundreds of billions of dollars in profits every single year. If you would like to flip the script on these companies and have them pay you for a change, then you may want to consider investing in bonds. And that's where our upcoming bond investing platform, Silo, comes into play. With Silo, you can lend money to the largest corporations in the world as well as the US federal government. These institutions will use your money to fund expansion efforts, research and development, and growth. And in return for helping them grow, they'll pay you back your money with interest of currently 4 to 7%. If you'd like to do that with no markups and the protection of $500,000 in SIPC insurance and $2.5 million in FDIC insurance, please consider checking out Silo in the description below. But anyway, if you want to build a massive tech company, it seems that you have to be willing to burn money for at least the first 5 to 10 years. But this is completely false. In fact, this was never a thing with traditional tech companies. Intel, for example, became profitable just 3 years after being founded. Apple became profitable just 2 years after being founded. And even Google, a modern tech company, only took 3 years to reach profitability. Also, it wasn't like these companies were burning money on user acquisition or marketing or insane amounts of overhead. Rather, they were just investing in getting their first product to market, and as soon as they were able to release their first product, they were able to become profitable. But all of this would change with a company called Amazon. Unlike the tech entrepreneurs that came before him, Jeff had a different perspective. Instead of trying to sell a superior product for a premium price, which makes it easy to achieve profitability, Jeff wanted to center Amazon around killing margins. His catchphrase was literally, "Your margin is my opportunity." But while this sounds nice on paper, it's not as clean in application, as this usually just turns into a race to the bottom. And that's exactly what happened. Most of us only remember Amazon and eBay, but that's not to say that they were the only players in the e-commerce market. They were simply the only ones who survived. The reality was that dozens of players entered the e-commerce market, strapped with the dot-com funding. This included companies like Boo.com, Webvan, EatToys, and Pets.com. To their credit, many of these companies actually did become quite large. Webvan, for example, was a grocery delivery business that's eerily similar to Instacart. Thanks to Dotcom funding, they were able to expand to 26 cities, hire 3,500 employees, and even have a billion-dollar IPO. But scale wasn't the only thing that these companies had in common. All of them were also burning ridiculous amounts of money. Boo.com burned through $135 million within 18 months. Pets.com burned through $300 million within 2 years. And as for Webvan, they were actually pulling in a good amount of revenue, $178 million, but their expenses were, wait for it, $525 million. This meant that for every dollar they pulled in, they spent $3. And it wasn't on building out their product or new features or anything like that. Almost all of the expenses of all of these companies was just marketing. In fact, Boo.com spent $25 million on advertising before they even opened. The cost of their product itself was minuscule for these companies compared to their other expenses. One of Boo.com's main technologies, for example, only cost $6 million to develop, but $135 million to market. With these sort of economics, it's no wonder why things eventually came crumbling down with the dot-com bust when all of these companies went under. After this disaster though, it seemed like investors had finally learned their lesson. Economics don't work differently just because it's a shiny tech company. But somehow, 20 years later, we would end up in the exact same position once again. So, what in the world happened? Likely the number one culprit that normalized money-losing tech endeavors is big tech, starting with, of course, Amazon. After the dot-com bubble, Amazon was feeling the pain just like every other dot-com company, but they had a rather unique solution. Instead of just trying to focus on profitability with their retail business, they decided to just open up a whole new business called AWS to pay for the unprofitability of their retail business. So essentially, they became their own funders, and I think we all know how this played out. Amazon would end up growing 500x and become synonymous with online retail, despite the fact that they were never able to consistently turn a profit to this day. Seeing this, many investors would start feeling a bit of FOMO. Maybe they were right about the dot-com companies all along. Maybe all the companies needed was a little bit more time and funding to succeed. After all, it took 20 to 30 years for Amazon to reach their stride. If Amazon was the only instance of this, things wouldn't have gotten so out of hand. But they weren't, which brings us into our next culprit, Google. Ever since Google became profitable, they've built a career out of building no margin/negative margin products. This includes Gmail, YouTube, Maps, Android, Google Cloud, the Pixel, and basically anything else that comes out of Google. Their strategy is to simply reach as many people as possible with these products and monetize all of them using Google Search and Google Ads. Once again, this ended up playing out extraordinarily well, as Google would end up growing 50x as they grew multiple ubiquitous platforms with billions of users each. But all of this was nothing in comparison to what Zuckerberg would do. Amazon and Google were simply subsidizing one in-house product with another in-house product. Zuckerberg, however, would go out of his way to buy money pits just for the users. This of course included Instagram for $1 billion and WhatsApp for $19 billion. While Facebook got a lot of flack for these acquisitions back in the day, these ended up becoming cash cows. Instagram is now valued at over $100 billion, and WhatsApp is likely worth even more. These big tech companies were clearly making a strong case for pursuing money-burning endeavors, but the factor that pushed investors over the edge was the exponential startups of the late 2000s. This of course starts with Uber. Uber was founded in March of 2009, and they're still not profitable, but they're worth $90 billion. Lyft was founded in 2012, and they're also still not profitable, but they're worth $4 billion even after falling 90%. DoorDash was founded in 2013, and they're still not profitable, but they're worth $30 billion even after falling 50%. Similarly, Stripe was founded in 2010 and is only now becoming profitable, but they're already worth $100 billion. I could literally name such companies forever. Robinhood, Coinbase, Grubhub, Airbnb, MongoDB, Zoom, Affirm, Carvana, Twilio, Snapchat, Okta, Rivian, Palantir, Peloton. Basically, any startup that you recognize and was founded within the past 15 years likely falls within this category, as dozens if not hundreds of money-burning startups were founded in the late 2000s and early 2010s and went on to be phenomenal investments despite never turning a profit. With each and every passing year, investors and VCs were becoming just a little bit more tolerant of losses, leading us straight into the pandemic. When the pandemic hit, investor FOMO went into overdrive. Tech companies seemed like a goldmine, as everyone was sitting at home spending all of their time on phones, computers, and TVs. All of the big tech companies started hiring like crazy as they thought this was it. This was the new frontier, the new era of tech domination. Meta nearly doubled their employee count from 44,000 to nearly 90,000. Google also nearly doubled their employee count from just over 100,000 to nearly 200,000. At the same time, big tech stocks and pandemic stocks were going insane, and VCs couldn't help but feel that they had missed out. And this is when they came to the conclusion. They may have missed out on this last run-up, but they sure as hell weren't gonna miss out on the next run-up. And with that, they started pummeling money into basically any startup that came through the door with insane valuation. And I think this graph really showcases the essence of what was going on. Back in 2012, there were a healthy 5 to 10 new unicorns every quarter. This increased to 20 to 40 in the mid-2010s before rising to 50 to 100 in the late 2010s. But then suddenly, it would explode to 220 unicorns per quarter in 2021. That's the same as over 2 unicorns every single day. And keep in mind, the stock market is only open 252 days per year. So really, 3 companies were reaching unicorn status on any given day in 2021. And make no mistake, this has nothing to do with rising innovation or more opportunity. The only thing this has to do with is VC funding and investor greed. I mean, just look at this graph. Funding literally grew 10x between 2011 and 2021. But the good news is that this madness is finally coming to an end, which just leaves us with the question, what happens next? Well, it's really simple honestly. A large number of money-burning startups will simply go bankrupt. This has already started to play out. Within just the first half of 2023, 338 US companies have filed for bankruptcy. 54 of these companies had a VC or private equity backing, meaning that if this trend keeps up, over 100 startups will go bankrupt by the end of this year alone. And as interest rates continue to stay high, the economic pain for these startups will simply get worse and worse. Most of the startups that manage to fend off bankruptcy for another year or two will likely be bought out by larger companies for rock-bottom valuations. If things play out similarly to the dot-com crash, only half of these companies will make it past this initial purge. Most of the companies that make it through will be a shell of their former selves with no way to return to their all-time highs. If we look back at their stock graphs in 20 years, it'll probably look something like this. Now of course, a select few companies will defy the odds and not only return to their former highs, but make new highs. These companies will become the new Googles, Facebooks, and Amazons of the next generation. But for everyone else though, this is pretty much the end of the road, as the VC money printer has finally stopped. Google is definitely feeling a lot of this pain themselves, but it seems like they've got a pretty good strategy to pivot. Check out this video to learn more, but until then, I'm Hari, and I'll see you guys on the next one.